Bond yields soar on today's surprise announcement from the Treasury Department regarding its debt issuance. And is the awful labor market finally starting to turn a corner? Before we get to the bond market, what is sending bonds sharply lower and bond yields sharply higher? We did get ADP private payrolls came in higher than expected, 42,000. Of course, rebound from the past 2 months of weak hiring, but the bounce was not broad-based. Education, healthcare, trade, transportation, and utilities led the growth. For the third straight month, employers shed jobs in professional business services, information and leisure, and hospitality. Here you can see overall private payrolls. Here is by establishment or company size. We can see small firms are struggling, while again, the large firms are doing well. Here's by industry, and of course, trade, transportation, and utilities making a notable increase, 47,000. Information down 17,000. Professional and business services down 15,000. Now, think of jobs that AI might be able to take. Education and health services, again, quite strong. This has been a trend for the past couple years. Leisure and hospitality down in a minor way. Here is the monthly report, but the white line showing that monthly figure, again, higher than expected. And then a 3-month and a 12-month moving average. And again, the moving averages don't look too good. We know the labor market has been weakening. By the way, here are wage growth numbers for those job stayers versus the job changers, and we can see it's been basically flat. Here, by the way, are job cut announcements from both Macro Edge and Challenger, and we can see that the job cut announcements have been declining, so the labor market might be starting to turn a corner. Now, to the bond market and what is sending bonds sharply lower and bond yields sharply higher, we got the quarterly refunding announcement. Now, this is a quarterly announcement by the Treasury Department on how they are going to fund the government. And this sentence in particular is sending bonds sharply lower. Looking ahead to, say, 2026, Treasury has begun to preliminarily consider future increases to the nominal coupon and FRN or Federal Reserve note auction sizes. Now, going over here, I made a bar chart from the QRA, and we can see nothing really notable here. These are the various durations expected for the next quarter or so. We can see no real change, no real notable differences there. And here's a table that shows that as well. But again, this sentence is what is sending bonds sharply lower and bond yields sharply higher. The Treasury Department, looking ahead to 2026, due to federal spending and the deficit, is looking to increase the size of coupon and FRN or Federal Reserve note issuance. And by the way, buybacks. A lot of people are interested in the buybacks. $38 billion in off-the-run securities across various different buckets for liquidity support, and up to $25 billion for the shorter duration, the 1 month to 2-year bucket. Now, coupon and FRN auction sizes, it's important to note those are those longer duration, not a treasury bill like a 1 month or a 3 month. Now, this is coming in the midst of a massive record pro-cyclical deficit. Now, pro-cyclical, what that means is, as we can see, the deficit has been worsening or going up in terms of GDP, despite the fact that the unemployment rate, headline unemployment rate, there are issues with the labor market, but U3 unemployment has been basically flat for the past 25 years. However, we have seen the deficit go from a 2% surplus to a 7% of GDP deficit. This is known as a pro-cyclical deficit. This is highly unusual. We should not be running such a large deficit. Now, 7% is basically unheard of outside of a economic catastrophe, a recession, or a world war, and we are in neither of those. Now, again, looking at the coupon sizes, this is a chart provided by Zero Hedge that you might find useful. Shows 2-year, 3-year, 5-year, 7-year, 10-year, 20-year, and 30-year sizes. Of course, we know activist treasury issuance started under the last administration, under Janet Yellen. What this has done is reduced the amount of long duration debt, and that has been priced into the bond market. Part of the reason that that sentence is sending bond yields sharply higher, it had been priced in that we were going to issue the vast majority of our debt in shorter duration bills. Now, a T bill, this is think like a 1 month or a 4 week or 6 week debt instrument, as opposed to, say, a coupon, which is, or a bond, which is a, say, 10-year, 20-year, 30-year sort of debt instrument. Now, these shorter duration debt instruments are much more cash like. Remember, a treasury is basically an interest bearing dollar. That is all it is, and it has a maturity. Well, the shorter the maturity is, the shorter the duration, the less volatility that there is. And therefore, T bills are very stable, and they can be readily levered into new US dollars. So again, they are much more cash like, more money like, more liquid, and therefore more stimulatory. And what we saw under the last administration, which was criticized very heavily by Scott Bessent, the current Treasury Secretary, but then continued by Scott Bessent, is a shift into more of these T bills because, again, demand has been objectively waning for those 10-year, 20-year, and 30-year longer dated debt instruments. And we can see the T-back recommendation. This is the Treasury Borrowing Advisory Committee. The T-back recommendation is 20%. Right now, we're running at about 23%. But again, remember these Treasury bills, there is a consequence to issuing all of your debt, financing your government in the cash markets, in the short-dated debt instruments, which is they are much more money-like. It is much more akin to printing money than issuing a 10, 20, or 30-year bond. Of course, it is coming at a time where debt to GDP is very, very high, remaining quite elevated. But here we see a familiar chart for those longtime viewers of the channel. Debt to GDP up top, US 10-year yield minus nominal growth. And again, the point here, if you can keep the cost of your debt, the interest rate on your debt below your nominal growth rate, things are actually okay from a debt perspective. And in fact, debt to GDP might go down. However, what we see is when the cost of the debt rises above your nominal growth rate, generally during a recession, as you can see, the vertical red shaded areas are NBER defined recessions, well, you start to have an increase in your debt to GDP. By the way, over the past 3 months alone, the national debt has grown by $1.4 trillion. Now, a large part of this is interest, of course, over $1 trillion per year. That is what is part of what is driving the deficit to these kind of insane levels. Well, if you can get the interest part of your outlays, your costs, your spending, if you can get that interest down by cutting the federal funds rate, kind of maybe more than you should, say if the federal funds rate goes to zero and you issue all of your debt in 1 month bills, remember the T-bills basically track the federal funds rate. There's no real movement in those T-bills. They are whatever the federal funds rate is. Well, if you just theoretically cut interest rates to zero and then issued all of your debt in T-bills, just using this as a hypothetical, is not to this point, but I'm just illustrating the concept. You can get interest expense down quite rapidly. However, there is a consequence, which again, those T-bills are much more money-like. They are much more cash-like. They are much more liquid, and they are much more stimulatory or inflationary because they are less volatile, and therefore they are more readily levered into new US dollars. Now, over the past 20 years, the debt has grown by 400%. GDP, or the economic output for the US economy, only grown 140%. Put another way, the debt has grown 2.8 times faster than the economy. So we are in an issue. We can see bond yields are moving sharply higher along with the dollar, continuing to squeeze. The 30-year, the 10-year, and the 2-year are up quite sharply on this quarterly refunding announcement. Here's the yield curve. Now, it's important to remember, since the Fed started to cut interest rates here back in September before the last election, bond yields at the long end have moved higher, really all the way through up until the belly of the curve. Bond yields are actually higher than they were when the Fed started this cutting cycle. The 30-year, for example, was at 4%. It is now at 4.7%. Same story with the 10-year, same story with the 5-year. And by the way, down here in teal is the 10-year Treasury yield minus the Fed funds rate. And I want to point out that it has been moving sharply higher. We actually have the 10-year yield above the Fed funds rate to a level that really hasn't been seen going all the way back to January of 2025. So remember, as the bond market prices in or prices out cuts, you will see move in bond yields. Well, we got a hawkish Jerome Powell at the last press conference. Yeah, they cut interest rates by 25 bips, but he was more hawkish and indicated that the future cuts might not be coming as much as expected. Therefore, you started to have bond yields move sharply higher. That is what kind of marked the bottom in bond yields. Well, this quarterly refunding announcement is only sending bond yields even higher than they already had been moving. So if positioning gets stretched and everyone is long bonds because they are expecting that there will be, say 150 basis points of cuts over the next year or 9 months or so, and Jerome Powell comes out and says, yeah, actually, we're not going to be cutting nearly as much. Well, those start to get priced out. And of course, if positioning is stretched, it just amplifies the move. So, by the way, should be noted that for the 2-year Treasury yield is up by 5 basis points. The belly of the curve, the 5-year and 7-year, are up about 6 and 7 basis points respectively, and the 30-year yield is up by 7 basis points. This is a notable move. It's not end of the world by any means, but of course, it is notable to have a quarterly refunding announcement. Now, the amount of debt that the QRA announced was in line with expectation. But again, there'd been this kind of baked in expectation of T-bill issuance. The bond market had kind of come to terms, okay, we're going to be financing the government in payday financing cash markets on a very short-term basis, while increasing those longer duration debt instruments, as the QRA noted, might happen over 2026, again, to deal with the fact that spending is out of control and we are running a 7% of GDP fiscal deficit. Well, the end result is you get bond yields moving sharply higher. And again, bond yields are inverse to the bond price. So when you have bond yields moving sharply higher, bonds are moving sharply lower. And again, ADP private payrolls did come in higher than expected. So this could also be some component. Of course, the government shutdown. We don't have any government data. We only have private data like ADP. So maybe the bond market is reacting in part to the beat that we saw with ADP. So anyways, hopefully that was helpful, and I'll catch you on the next one.